If you have a mortgage coming up for renewal in the next few years, I want you to watch this video. By now, you should know that your payments are likely going to increase, and I'm going to talk about 6 different tips to help you navigate your renewal. Number 1 is to stay updated and aware of what your new payment could actually be. It's best to reach out to your mortgage lender or mortgage broker to see what the new payment could be. Leading up to your mortgage renewal, or even when you have received the renewal documents, it's still good to reach out to other lenders and see what other options there are, so pretty much shop for better interest rates. There has been a lot of panic of higher payments upon renewal, but it is really case by case. Really see what your payments could be and assess your situation from there. I have met some people with very low mortgage balances that even at today's higher interest rates, the payment wouldn't change much. I personally think those with mortgage balances of over $900,000 would feel the pinch the most, as your payments will increase by about $2,000 per month. If the quoted new payment is much higher than expected and not manageable, there are other solutions that I'm going to explain later on in this video. For number 2, keep in mind that if you are in a variable rate mortgage with payments that change, you have already felt the pinch at the higher rate and at a higher payment that no one seems to be talking about. Keep in mind that even if your mortgage is still coming up for renewal, your payment could change if the discount provided on the existing mortgage changes after renewal. If you are in a variable rate mortgage with static payments, meaning that your payments don't change, and if you have hit your trigger rate, not increasing your payment is the worst thing you can do right now. Usually in a mortgage payment, a portion goes towards principal and a portion goes towards interest. As the rates continue to rise, your share of the interest payment usually increases as well. Now, when your payment doesn't cover all of the interest, that's when you hit your trigger rate. This will lead to a longer amortization on the mortgage, as now you're paying interest on interest. On renewal, your lender will likely re-amortize that mortgage, and you will definitely be in a payment shock. It's best to call your lender and increase the payment to cover some principal, or make a lump sum payment to bring the mortgage balance down and to help with your amortization. If you are in a fixed rate mortgage, you know when your mortgage renewal is going to be coming up. In preparation for it, you can put money aside to help supplement those payments later on, or to pretty much make a lump sum payment. You have the added advantage of having a time frame to prepare. Know that there's an option to extend the amortization. Let's look at an example. Since it's now 2023, let's think 5 years ago. Since the average price per home back then was $788,000, let's say you put 20% down and took a mortgage for $630,000. Your payments at 2.5% would have been $2,487. Now, this is over 30 years. 5 years later, remember that you would have paid down some principal, and your mortgage balance now would be $555,088. Your new payment at a higher rate of 6.5% will be $3,718 over 25 years. Now, extending that amortization back to 30 years will reduce the payment to $3,477. Now, I know a lot of people will be complaining about extending amortizations and so on and so forth, but the truth is people have been refinancing their mortgage, consolidating their debts and renovations, and extending amortizations well before this high interest rate environment. Now for number 6, now this is worst case scenario. If the payments are not manageable, then you obviously have the option to offload and sell that property. Now that's a totally different topic that I can definitely explore in a new video. This is Kokilan from Remax, Metropolis, and Paper Planes Group. If you have any questions, reach out to me at the contact below. Bye for now.